Today, I'm going to be ranking and quickly and efficiently analyzing all 30 stocks in the Dow Jones Industrial Index today. I'll share my thoughts on the company, if I'd ever look to buy or add to my portfolio, talking about the financials very briefly, and so much more. And guys, you've just been stopped at the tool booth, and all you gotta do to get by is hit that subscribe button for me real quick. On this channel, I enjoy analyzing, studying, and looking at businesses and stocks. So if that interests you, I'd love to have you along for the ride. And if you're already here and you want to go the extra mile, make sure to check out becoming a channel member today for exclusive episodes, stock market competitions, and so much more perks on the way soon. And with all that out of the way, roll the intro.
Hello, I like money.
Alright, to start off, we're going to go with a hot one, which is a controversial one as well, which is, of course, 3M, the industrial giant. Now, I feel a few years ago, 3M would be trading in that A to B tier range, in my opinion, or in that ranking area. 3M as a company is a giant, and there's a slogan that you're never 10 feet away from a 3M product, which I feel couldn't be more true. They make all sorts of products, whether it be Scotch tape, industrial tape, so much more stuff that they make on a day-to-day basis used by millions of people. As I mentioned, though, the last few years have been horrible for 3M. Something catastrophic would have to happen just a few years ago for them to be in the position that they're in right now, and it's pretty much happened. They've been dealing with lawsuits over forever chemicals, the military earplugs, and so much more stuff that's clouded over their business over the last few years. As a result of these lawsuits and the settlements that they've had to pay, their free cash flows have been impacted. They've had virtually no dividend growth in the last few years with very tiny increments and hikes. With that said, in the most recent years, 3M's profitability has also dropped, but a big positive in the company right now is the revenue, which has consistently gone up. 3M stock has been getting killed over the last few years, and in many valuation metrics have the stock as being undervalued right now. Keep in mind the market wants predictability at the moment, and 3M is the farthest thing from that. Recently, there seems to possibly be some positive news, though, with 3M, as they have reached some settlements on their forever chemicals and earplug lawsuit. With that said, 3M has a lot of unpredictability right now, especially with that dividend in the future, and for now, it's in the C and D tier. I do feel, though, if these lawsuits weren't a thing and 3M was performing their business as they were just a few years ago, they'd be in the A or even B tier. Right now, I feel if you're buying 3M, there's a lot of risk involved, but there are also some reward. Me personally, I do own 3M in my portfolio. I bought in before these lawsuits were even a thing. As for right now, I'm holding and praying with the company. I do believe, hopefully long term, they can recover. Alright, moving on, we have the insurance giant, the Travelers Companies. This is basically an insurance company. They've had solid price appreciation in the last few years, and also have a solid growing dividend as well, with their last hike being at 7.5%. Now, me personally, I'm not invested in any insurance companies at the moment. I'd have to do more research on them, and I've honestly just been introduced to the stock over the last couple months. Over time, they're also buying back shares at a pretty good rate as well, which is a positive thing to see, and if you're a long-term shareholder of any company. They also have really solid and impressive free cash flow and revenue growth per share as well. It's definitely a stock that I think I'm going to need to start eyeing, looking at the financials, and doing more research on. Financially, they do look very strong as a company, and there's no major red flags from first glance. With that said, though, this is one of the first times that I've ever really deeply looked into the company's financials. Let me know in the comments if you own the Travelers Companies. Financially speaking, it looks very strong as a company, and I put it in the B tier for now. But there could be something that I'm missing, as I'm not an expert on these type of companies at all. Alright, to continue stirring up the pot a little bit, we got another controversial giant of a company, which is of course Disney, stock ticker DIS. Now, Disney, along with 3M, just a few years ago, it seems like one of those stocks that would never go down and something catastrophic would have to happen for the company to crash. And of course, that thing happened. Right now, the big thing with Disney is that they're not really profitable as a streaming company, which is where the main part of the business is at right now. Disney, along with 3M, is trading at a huge market decline at the moment due to everything that they've been dealing with, whether it be C-19, politics that they've gotten involved with, or other issues that they've just been dealing with. Disney is another one of those companies right now that it seems like its stock price will never go up no matter what happens. Now, the big thing for Disney is if they get that streaming profitability up by 2024. As I mentioned, the market wants certainty right now, and Disney's free cash flow is not recovered to what market analysts and other people have thought they would recover to by now. But if Disney can get their streaming profitable, they can get free cash flow positive and continue growing that. Another thing I think is noteworthy talking about Disney as well is their parks business. While their parks business is very strong, it seems that it's very profitable, and demand always seems to be high. Now, the big issue with me personally with Disney's parks business is how are they going to continue to grow it? they can only do so many price hikes. I understand they've been doing price increases, price hikes. You get to cut the line if you pay more money. That's good and all, but you can't build new parks. It's straight up like there's no cap, there's no crazy growth to be tapped into. There's tiny things that they have done, like price hikes, as I mentioned, that they will probably continue to do, but you can only do that for so long before people stop coming to the parks. Disney put all their eggs in one basket with streaming, and so far it hasn't paid off. Now, over the long term, I believe in long-term investing, so I'm being patient right now personally with my Disney shares, but as for now, I put it in the C to D tier. I think as a couple years ago, they were in the A or even B tier, but this just goes to show with 3M and Disney that nothing is predictable and nothing is guaranteed in the future with your stocks. Alright, the next company we're going over is Goldman Sachs, and for Goldman Sachs, I put it in the C tier. While Goldman Sachs had an aggressively growing dividend and also bought back shares, there's a big metric that is a big concern for me, which is the negative free cash flow per share at the moment. There isn't any consistent free cash flow growth also with this company. Goldman Sachs has solid revenue growth, but they can't seem to convert it into consistent free cash flow growth, which is one of the big things that I want to see in my companies. With my companies, I want to see consistent, large, free cash flow growth quarter after quarter, year after year. And it just doesn't seem that's the way with Goldman Sachs at the moment. Am I saying it's a bad stock? No whatsoever, and I can see that it's in the B tier right now, but I put it in the C tier. I'm also personally not a fan of investing in a financial service company such as Goldman Sachs, so me personally, I'm avoiding. I'm not saying that it's a bad company whatsoever, just me personally, I'm not buying, so I put it in the C tier. Alright, moving on to Merck & Co., and for Merck & Co., I put it in the B tier. Merck is one of those pharma and healthcare giants. Now me personally, I'm investing in AbbVie for my pharma exposure and J&J for my healthcare exposure. Pharma is a very dirty business, you guys, and you got to do your research when investing into these companies. There's so much going on and so many parts moving. With that said, though, Merck's financials are pretty sound. They've pretty much been buying back shares since 2010 and also pay a solid growing dividend. It's really nothing special, but it's above inflation at that 6-7% range. It's solid dividend growth overall. Merck has a solid revenue growth in the last couple of years and also solid free cash flow growth as well. The free cash flow is a little slower and more inconsistent than that revenue, but it still is large. As I have mentioned with these pharma and healthcare companies, guys, there are a lot of moving parts in these businesses and you got to really do your full research. For me, AbbVie and J&J is enough. I'm not personally looking to add Merck to my portfolio, but pharma is one of those dirty industries with a lot of skeletons in the closet that rake in consistent and large profits every year. As a shareholder, that's the kind of business that I want to be in. So me personally, I'm not buying Merck right now, but it would definitely be worth researching if you're looking for a pharma company to own. With that said, though, I believe Merck could give you some solid exposure if you're interested in investing in animal pharma, animal healthcare products, etc. Alright, moving on, we have an S tier company, which is of course Apple, stock ticker AAPL. I've been talking about Apple a lot recently, and today they're actually down 4%. So I'm licking my lips at a potential dip to add to my Apple position. Right now, for me personally, I'm looking to add at Apple. If it gets it below that 170 range, it's definitely intriguing for me. Apple is such a strong company, and while they're not necessarily much of a dividend company with their lackluster dividend growth compared to their free cash flows, they're such a strong business nonetheless. If you look at their innovation and their leadership, I think that's the big advantage they have. They also have a moat over the cell phone market. It seems like Apple's one of those companies that they can walk into any industry and they can just dominate straight alone. Whether it be healthcare with their glucose monitoring and Apple Watches, whether it be the future VR headsets they have coming out, or whether it be cars in the future, it feels like Apple has so much potential with the company. And a lot of bears on Apple will say that their revenue can't keep growing at this level and that they can't keep growing, and that's what they were saying at $500 billion, that's what they're saying at $1 trillion, and that's what they'll continue to keep on saying. Nonetheless, Apple is such a strong business, and there's a reason Berkshire Hathaway owns nearly 50% of Apple in their portfolio. Apple's share buybacks are crazy as well. They've bought back nearly half of their shares over the last decade, which is just insane. Apple's also been one of the best total return stocks to own over the last 10 years as well. Now, me personally, as I mentioned with my Apple, I would be looking to potentially add at 170 or below. I believe this is that strong of a company. Apple produces large, consistent free cash flow quarter in, quarter out, and it doesn't seem like they can slow down. They're also tapping into new emerging markets, as I've mentioned, with their Apple Pay card. Apple's dividend growth has been pretty much a little above inflation, and a lot of investors are upset at that, With that said, though, they are spending all that money that they would be paying on a growing dividend on buying back shares, which I think right now is the smarter thing to do. With that said, I think as Apple becomes more mature of a company and they can't intelligently reinvest those free cash flows, they're going to have a crazy growing dividend, and your yield on cost could be insane if you were to buy. So for me, there's no doubt that Apple is an S-tier company. Alright, moving on from our S-tier companies, we're going to quite the opposite of that, which is an F-tier company, and unfortunately, I'm going to have to place Walgreens in F-tier. Walgreens has been a struggle bus recently. They've posted recent horrible earnings reports. I recently sold my Walgreens just a few months ago. I sold my Walgreens and I viewed it really as a Band-Aid rip of a company. Band-Aid ripping, if you guys don't already know, it's basically when you have a bad company in your portfolio that you can't really support your original thesis of buying, and you just sell off the company even if you're selling at a huge loss, and you just reallocate the funds somewhere else, and that's what I did really. Walgreens, it was just a complete horrible investment from the first place. It was one of those companies that when I initially started dividend investing, I was really enthusiastic about buying stocks. It was just one of those companies that I thought would be around for a while. It's an okay quality company in my opinion, and I just thought they would reward me with that crazy dividend yield, and at the time in the $40 range, low valuation. That was a value trap looking back on it for sure. Recently though, Rosalind Brewer, their CEO, who I've made a video on, actually left the company. She resigned. In a time in the stock market when no investor wants to be around retail due to theft and other issues, Walgreens just stands out as one of those poor quality companies. I've noticed in sector-wide trends like that, usually the lowest quality companies are the ones that dive down furthest first. At the moment of this video, Walgreens is an F-tier company. There's nothing really appealing about it compared to the other investments that I'd look for. Alright, we just talked about Apple, and now it's appropriate to talk about IBM, which I put in the D tier. IBM has underperformed the market so bad in the last decade, it's not even funny. IBM, just another one of those companies. You could be on top of the world at one time, but nothing in the stock market is predictable, and you need to really do your research on businesses. Over the last 15 years, they've pretty much been trading flat. Their dividend is really nothing to write home about, with their dividend growth being under inflation at the moment, nearly at 0.61% at their last hike. I think this one is a little self-explanatory, so I'm going to move on to the next company, but for IBM, I put it in the D tier, very close to the F tier as well. While we're on the topic of companies struggling to make free cash flow, let's move on to our next company, which is of course Boeing, the airplane part giant. Now, Boeing was one of the first stocks that I ever really looked at, especially during 2020 when everything crashed. I just thought Boeing was one of those companies. Their airplanes are always going to be needed, and they're a giant. They're also trading at a really expensive price at the time, and I saw a huge dip, and I immediately thought it would be a good time to buy. I never went through on that purchase, fortunately, because it's still down to this day, with some decent performance as of late, but not going back to their pre-C19 levels. Right now, it seems that Boeing is really struggling to turn free cash flow at the moment, and as an investor, that's nothing you want to see. Another red flag I see is that they're not buying back shares right now at this low time in stock price. They also have suspended their dividend ever since C19. Right now, it just seems it's a company that's really struggling to recover. I put it in the C/D tier. Alright, next we have American Express, the financial services giant. American Express has a very strong growing dividend, with their last hike being near 15%. Amex has also had a really strong share purchase program, recently buying back 4.8% of shares. Amex has also had really strong free cash flow growth over the last couple of years as well, and overall, I believe they're a very strong business looking at them financially. Right now, I put Amex in the B tier. I think it's a pretty strong quality company. The free cash flow growth isn't as consistent as I'd love to see it, but nonetheless, they do look financially sound, and I haven't done any crazy deep research on the business itself. Alright, moving on, we have Amgen, and for Amgen, I put it in the A tier. Amgen is a therapeutic giant and has performed greatly since 2010. They've also been buying back shares at a really aggressive rate, last year buying back nearly 5.5% of shares. The company produces a really solid amount of free cash flow compared to some of its other peers. The issue is, since 2018, that free cash flow has been a little stagnant, but overall still trending in the positive direction. With that dividend, they also buy back shares and pay dividends. Moving on to the dividend, they have a really solid growing dividend, which pretty much is in line with their free cash flow growth, with an average growth rate of 10% on that dividend, and I would expect that to continue. Right now, last quarter, it seems like they had a really solid quarter for free cash flow, and I'd like to see them continue it. Amgen's a very strong company financially, and I put it in the A tier. Right now, I don't own any Amgen, but I'm looking into it and researching it possibly. Next, we have Cisco, and for Cisco, I put it in the B tier. It was very close to being in the C tier, though, but they've had some really solid quarters in the last few, with increasing free cash flows and more. Their dividend is really nothing to write home about, with growth under pace of inflation at 2 to 3% annually. Hopefully, though, with the recent free cash flow spike like that will be increasing. In 2022, they had a 50% increase in their free cash flow per share, and if they can consistently maintain that and grow that from there, I think it will definitely be a staple of a B tier company. With that said, though, it was very close to being in the C tier, but with the recent performance they've had, I believe it to be in the B tier. Right now with Cisco, I'm not personally looking at, and I don't foresee myself buying into this company in the future. Next, when you tell me to think of a really quality industrial company, one of the first names that comes up is this next company, which is of course Caterpillar, stock ticker CAT. And for Caterpillar, I put it in A tier without any doubt. Caterpillar's dividend growth has been really impressive as the last couple of years, and it's just one of those companies that never seems to be on a dip. Unfortunately, Caterpillar's been really recognized as a high quality stock by the market and is currently trading at all-time highs. They've had really quality and sustainable dividend growth over the last few years, ranging from 8 to 10%. Over time, their share count has also been decreasing, but not at such an aggressive rate, some like these other companies. Ever since 2016, Caterpillar's consistently grown their free cash flow per share, a positive that you want to see in any company, and it seems that their consistency has been rewarded by the market, as I've mentioned, as they're trading at really all-time highs. There's no doubt that Caterpillar is a staple of a company and likely isn't going anywhere for a long time. Unfortunately, it's trading at all-time highs. It's been recognized by the market as one of those premium companies, and it's trading at that premium for sure right now. I put it in the A tier. I think it's a great company. I would love to add at the right price. Alright, next we have the chemical company Dow Incorporated, and for them, I put them in the C to D tier. This is a company that Dividend Data actually has talked about early on in its investing journey, and a lot of investors actually get trapped into the stock because of their name itself. Also to the fact that it is a really high starting dividend yield ranging from that 5 to 6% range. They've had lackluster EPS growth. Also, Dow hasn't grown their dividend in a while, and it seems that their financials have been lacking for a little bit now, which is not a positive that I want to see in any company. There's just no gapping and urging desire to buy into this company whatsoever for me, and their free cash flow has been a little inconsistent for my liking, and there's just no urging desire, as I mentioned, to really buy into them. So for right now, I put them in the CD tier. Alright, next we have the oil giant Chevron, stock ticker CVX, and I actually used to own Chevron back in the day, but unfortunately I sold for a better opportunity before it just had a crazy price hike. Chevron, I think, is a time that you ideally want to buy in a cyclically low time for oil like 2020. With that said, these companies do pay a lot of their profits back in the form of dividends as they're more mature and they can't intelligently reinvest them for any crazy growth or whatever. Another thing that I think it's noteworthy to mention with these type of oil companies is the possibility of a dividend cut. They do manage their financials and their cash balance sheet, so during the good times and the bad times they keep consistently paying that dividend yield. But as a younger investor, I'm looking for dividend growth and free cash flow growth overall, and that's just not something that I really ideally see with these companies. With that said, though, they're still monopolies, and I do feel the world is going to be relying on oil for a long time to come, and that the EV craze isn't really that big of a threat as people are saying in the news. I do think over time we are going to manually kind of, go over to EV, but with that said, though, I don't think oil is going anywhere for a long time. Would I ever buy into Chevron again? If there's a really cyclically low time, like a historically low time to buy oil, I'd probably buy a little bit. But as right now, no. But as for now, I put Chevron in the B tier. They're nothing crazy of a company. With that said, though, they're a very mature business, very monopolistic features, and definitely isn't the worst of the worst. Alright, next we got the industrial giant Honeywell, and for Honeywell, I put it in the A tier. Honeywell is a very strong growing dividend. They produce consistent, large free cash flow quarter after quarter. Over time, they've also gradually bought back shares as well. A bit of a concern right now for Honeywell is that their revenue has been a little flat when it comes to the growth metrics over the last 10 years, only going up 0.62%, but nonetheless, they're printing money right now. Honeywell is a giant of a company. They're very difficult to beat, high barrier to entry to compete with them, and a very mature business overall. Now, me personally, I'm not buying any Honeywell right now. The growth rates are a little slow, and it's not particularly jumping out of my eyes right now when it comes to the valuation side of things, and I don't need another industrial company in my portfolio at the moment. So for now, I'm just looking at Honeywell. Alright, I love my healthy and competitive dividends, and for this next company, you could argue against that, which is of course Intel, stock ticker INTC, which I put in the C to D tier. Now, Intel is definitely a turnaround of a company if you're buying in at this time right now. I was very unknowledgeable when I first bought my Intel. When I bought it $55 a share, I bought very fast because of other YouTubers, and I was getting FOMO basically. I paid for that mistake, and I sold out of my Intel at a pretty big loss just a few months ago. I reallocated that capital elsewhere where I hope long term I can make up for those tiny losses I had. The mistake that I personally made with Intel was I had FOMO of missing out on the potential recovery that they had. Unfortunately, I didn't do my proper due diligence and completely look into the bear case as well, which is what happened at the end of the day. Also, I don't believe it's one of the highest quality companies in the world, and it definitely wouldn't meet the qualifications for a company I'm looking to add to my portfolio today. I also got influenced by a lot of other people in the investing community to buy into this stock without really letting that info sink in. Another thing with Intel is that their CEO, Pat Gelsinger, was a huge reason why I was bullish on the company personally. He seemed like a madman who was dedicated and was the guy for Intel, and he just really wanted to be there. I think as a businessman, I don't think he's the best CEO whatsoever when it comes to managing financials, new projects, capital expenditures, etc. And it showed. Intel is definitely in a recovery phase at the moment, and I put it in the C to D tier. With that said, though, if all their plans go to execution, they continue winning back market share, I could see them being a B tier company for sure. Me personally, with my capital, I'm not touching Intel at the moment. Alright, this company just had its national holiday on the Discord link in the description, which is of course Johnson & Johnson, stock ticker J&J. J&J Day is whenever J&J pays out a dividend, we celebrate J&J Day. Johnson & Johnson is one of the world's biggest healthcare companies at the moment. They produce countless items that millions of people use every day, whether it be healthcare or their Kenvue that they just spun off. J&J is definitely one of the most mature companies in the world. Unfortunately, Johnson & Johnson has not had any crazy growth, but they have reliably paid and grown that dividend over 60 years. While Johnson & Johnson is definitely a slow grower, especially for me, I'm personally a young investor, it is such a solid company, and I put it in the B tier. With J&J, you can expect annual total returns of 7 to 9%, which is underperforming the market unusual, but they're such a staple of a company and investors are willing to pay a premium for that. Now, me personally, if I'm looking to add to J&J, it has to be at a really attractive price to lock in that good future return. They're definitely a solid company, but they aren't one of those compounders like Apple, Microsoft, etc. that we always talk about, but they're definitely a staple of a business and such a mature company, and for that, I put J&J in the B tier. While we're on the topic of boring, mature companies that are trading in an overpriced valuation, next we have Coca-Cola, stock ticker KO. Now, dividend investors have an emotional attachment to this company, probably because they grew up drinking Coke, Warren Buffett owns it, or some other reason, and they're just holding on to it. Unfortunately, at current prices, Coke is nowhere near a buy in my range. With that said, though, they're a very, very mature business, and they're a staple in the beverage industry as well. You could even say they have a moat. There's no doubt that Coke is a solid company, and while their payout ratio is creeping a little high, I don't think they'll be cutting their dividend anytime soon, as long as they keep producing that free cash flow that they have been producing. My issue with Coke is the valuation, and that's been the concern for a long time with this company. They're trading at a very lofty valuation, and the same valuation as giants like Apple and Microsoft. Me personally, for a company like Coke that's kind of underperformed in the last few years, I'm not willing to pay that premium. But at the right price, I think Coke is definitely a buy. Something crazy would have to happen, though, in my opinion, for Coke to go on a crazy decline where it's actually a really attractive buy. They've been really trading at this premium valuation for a while now, and it doesn't look like they're going to go on a crazy dip anytime soon. Coke is definitely a solid business, though, overall, and for that, I put it in the B tier, but the little underperformance and the slower growth is a bit of a concern for me as a younger growth investor. Alright, while we're talking about overvalued companies, the next company definitely fits into that, but they're a bit of a better company, in my opinion, than Coca-Cola, which is, of course, the restaurant giant, the fast food icon, McDonald's, stock ticker MCD. McDonald's is an amazing business, there's no doubt, and their growth rates are actually really solid. The issue again here is the valuation. In 2022, when everybody thought we were going into recession, these kind of stocks that were quote-unquote recession-proof, like Coca-Cola, McDonald's, etc., started trading at a crazy premium that we're just unwilling to pay as a long-term investor. With that said, though, McDonald's growth rates are definitely improving as well, and it's a company that if it gets to the 250s range, I'll definitely be watching personally. I already own a decent amount of McDonald's. I got my cost per share down in the 210s, 190s when I started buying a few years ago, but definitely at these current prices, I'm not looking to add anytime soon, unless we're going a sizable dip. There's no doubt, though, the quality of the company. It is such a strong business overall. Every McDonald's you go to, you know the consistency that you're going to get. They produce free cash flow. They have a very solid growing dividend as well, way above inflation. Overall, I think McDonald's will also benefit with the overall robotics and automation and even the little AI trend that we have had. I think a lot of restaurants, big scale restaurants, especially like McDonald's, can benefit a lot with that, and they've already been toying around with that in their drive-thru. McDonald's is definitely an attractive company, but it has to be at the right price. 250s I'll start watching, but for now I put McDonald's in the A tier. They have really solid growth rates, and the valuation's really out of their control. Very solid business overall, though. Next up, we got the highest quality company in the world, which is of course Microsoft, stock ticker MSFT. Microsoft has so many business segments, whether it be their cloud, their gaming segment, which I'm really bullish on personally, or the other business segments that they have. It's one of the most diverse and fastest growing businesses in the world. They also have a moat. It is nearly impossible to compete with Microsoft these days. You can give me $500 billion and tell me to compete with Microsoft, and I straight up couldn't. And Microsoft was one of my favorite companies in the world until they completely whooped Lena Khan in the FTC in their court case over Activision Blizzard, and that made it my favorite company in the world for sure. I think their biggest potential right now is not only with cloud, but I think their gaming business is going to be very, very underrated coming up in a couple of years. I believe they can become the Netflix of gaming, but unfortunately there are some monopolistic concerns regarding Microsoft. Will it actually go through and they'll be forced by government to split up? I don't know. Microsoft's free cash flow growth is a thing of beauty. Financially, they're really as sound as a company you can get, unless there's one other company on this list that I haven't talked about yet, which I think is more financially sound, wink wink Visa. But I do think, their dividends and share buybacks are great as well. Their dividend is basically an outcome of their free cash flow growth. It's pretty much consistently 10% annual dividend growth. They're set to hike it up this coming month, and I will literally predict on here 10%. There you go, Twitter. At the moment of recording this video, Microsoft is the largest position in my portfolio. It's trading in the 330s at the moment. For me to consider adding and dollar cost averaging even more into this wonderful business, which I'd love to do, by the way, I think it would need to get the 280s, 270s, and I'd definitely start averaging there. Alright, next we have the most iconic clothing brand in the world, and I'm currently wearing one of their shirts right now, which is Nike, stock ticker NKE. Anytime you have a brand that can get a $20 pair of shoes and price it for $450 and sell it instantly, it's definitely something that you want to have. Nike's been known as one of those companies that always trade to the premium, but recently they've been on a bit of a dip. There's no doubt for me personally putting Nike in the A tier. They've had very strong dividend growth, very strong free cash flow growth, and very strong financials overall if you look at it. I think one of my favorite things about Nike though is how they've really stayed around even during all the fashion trends over the last 10 to 20 years. It's also really a nice story around the company. I personally read The Shoe Knight by Phil Knight, and it was very interesting to see how the company is built up. With that said though, I don't think Nike's going anywhere. Kids are going to be wearing Nikes, adults are going to be wearing Nikes, and their clothing brand is just one that's unreplaceable and very hard to compete with. I personally think they have a moat. I do think the big issue with Nike right now is the valuation, but they have been on a bit of a dip recently with all the theft issues. So I think now might be a nice time to potentially buy some Nike. I'm liking it in the 90s. It's a wonderful brand, a wonderful business, and for that I put it in the A tier. Not to mention their financials are really good as well. Alright, next up we have Procter Gamble, stock ticker PG. Procter & Gamble is a weird one because it really is a mature business. It's a staple. People use their products every day, and they produce large amounts of free cash flow quarter after quarter. With that said, though, the growth rates are slowing down a little bit, and it's just not a stock that me personally, it's kind of like with Coke and J&J as well. They're very strong, mature businesses, but it has to be at the right valuation for me personally to buy. Their growth rates are really nothing to write home about. It's underperforming the S&P 500 when it comes to growth rates and total returns. With that said, though, they're very strong businesses and they're amazing companies to own at the right price. At the right price is the huge thing I want to nail home with you guys. They're good businesses, but only at the right price. If you're paying a crazy premium for them or not really looking at valuation, it's just going to be underperformance for you. So I put Procter & Gamble in the B tier. I think it's a strong, mature business overall. Very boring company, so I put it in the B tier for that. There's nothing crazy going on. Alright, next we have Salesforce, and for Salesforce, I put in the B tier. Currently, Salesforce doesn't pay a dividend, but they're a wildly profitable company, and they have beautiful free cash flow growth. They also, unfortunately, don't buy back shares, and they've been diluting shareholders for a bit now. But anytime a company's free cash flow kind of mirrors that revenue growth, it's a really good sign for a company. They're very profitable and their profit margins are pretty strong, but I put Salesforce in the B tier. I think it's a solid company overall. Me personally, I'm not looking to add any right now. Alright, next, every white dad in America will be all fired up about this one, which is of course Home Depot, stock ticker HD. And for Home Depot, I put it in the A tier. Not only are they in a duopoly right now with Lowe's, but they're also a very cyclical business when it comes to real estate and what people are buying for their houses. Home Depot produces a solid amount of free cash flow growth. Not to mention, they also do pay a really aggressively and strong growing dividend and has been recognized as a really strong dividend growth stock. Now, me personally, I am looking at Home Depot, but again, it has to be at the right price. I'd like to buy in ideally during a cyclically low time. A recession would be nice to buy this stock. But overall, I'm a fan of Home Depot. I like the brand. I like the pricing power that they possess. And after that, I put it in the A tier. Next, we have the healthcare giant United Healthcare, which is a stock that I've been personally watching for a while now, and I put it in the A tier. I will be honest, guys, this is very close to being an S tier company, but it's such a giant of a company, and there's so many moving parts where you have to really do your due diligence when picking this company to buy. UNH is a massive company and has been rewarding shareholders for a bit now with a really aggressively growing dividend. They print free cash flow quarter after quarter, and they're really a strong business when you look at its core. Now with UNH, when I'm personally looking to buy, I like it at $450, $460, and I don't own any right now, but it's definitely a company that's been on my watch radar for a bit now. UNH is just such a giant of a company, and they're really hard to compete with, but a concern that I do have is possible government intervention and how big their business really is at this point. But for UNH, their financials check out, and it's a really strong business overall, so for that, I put it in the A tier. Alright, next we have Chase, and for Chase, I put it in the B tier. Another one of those financial bank kind of companies. I'm just personally not a huge fan. I'm not really looking to invest, but their financials are solid. They do pay a solid, decently growing dividend as well. They're a decent company to have some decent returns, so for that, I put it in the B tier. I'm not personally going to be looking at it anytime soon, though. Alright, next we have the dividend yield telecom giant Verizon with their 7% dividend yield. Now, Verizon's weird because really it's not an attractive company whatsoever. Telecoms have been known to historically underperform the market and just pay high dividends with lack of dividend growth. Verizon actually just hiked their dividend 1.9%, which is under inflation right now. Not a very good thing to see, but a lot of older investors do own the stock as it is definitely more conservative when it comes to growth, and I would say that it's reliable, at least compared to AT&T, when it comes to their dividend stability and how likely they are to cut it or pay it. With that said, though, Verizon does have some issues currently going on at the moment. They have old telecom cables that are possibly contaminated with lead and have done damage to children, so that's a huge issue that them and AT&T are going to have to deal out with over the next couple of years, and their stock price has been impacted by that, but I put them in C/D tier. They're really not a great business overall to own unless you're like a retiree looking for that dividend income, and overall it's just going to underperform the market in my opinion, and it's going to continue doing that. Next we have the most financially sound company in the world, which is of course Visa, stock ticker V. V basically has a duopoly right now with MasterCard over the payment processing industry. Their payment processing network is really impossible to compete with. Every time somebody uses a Visa or a credit card through Visa's processing system, Visa collects a fee. They're a tool booth of a company, which basically means they collect fees, sit back, and let their business do its work. It's a very simple business to understand at the end of the day, and it's a very effective business when it comes to producing free cash flow. Visa produces consistent free cash flow quarter after quarter, year after year, and rewards shareholders through a really nice, aggressively growing dividend and buybacks. Really, if you look at Visa's financials, they're as sound as you can get, and there was no doubt for me putting Visa in S tier. Visa's total returns are insane, and if you would have bought in 2010, your yield on cost would be over 10% right now. Keep in mind the dividend yield at the moment is at like 0.76%. When would I actually buy Visa though? Visa I think is fair price in 220, 230 range, and I would like to add in 230s. I am beyond willing to pay a bit of a premium just to own Visa at the moment. I think it's going to produce great returns over the long term, and I think it's definitely deserving to be in the S tier. And lastly, we have Walmart, Target's rival, and for Walmart, I put it in the C tier. Walmart's financials are really not that great. Their profit margins are razor thin. Their free cash flow per share has basically been flat over the last decade, which is definitely not something that you want to see. Out of all the retailers, I am personally invested in Target, but there's other reasons to that. I think Target's free cash flow growth is better than Walmart's. I know Walmart does have technically the bigger brand, and they're the bigger retailer of them all, but just because they're biggest doesn't mean that they're best operated. I feel like every time you also walk into a Walmart, you do get a weird feeling look at some of the people there, and that's just not something I want to see in a company I look when I invest in. So for Walmart, I put it in the C/D tier. It's probably lying in the C tier range, but definitely if it could get more consistent free cash flow, more consistent profitability, it would be a better stock. I also do think that they are wildly overvalued right now, and I'm not looking to add Walmart to my portfolio anytime soon. And those are all 30 stocks ranked. Let me know your thoughts in the comment section. Which ones did I rank right? Which ones did I rank wrong? I'd love to hear your opinion, to be honest. If you made it to this part of the video, I want to thank you so much. If you haven't already, hit that subscribe button, smash the like button you're at it. Become a member today for exclusive episodes, perks, so much more stuff coming soon for that. Thank you, and of course, do dividend stocks, not drugs. Have a good one.